Hello everyone. Welcome to HSBC Mutual Fund's Fixed Income Outlook for 2025. Year 2024, by all accounts, has been a tough one, especially for global macro analysts and traders. Through all this volatility, India's calendar year 24 scorecard shines out compared to the performance of most emerging markets. With equity markets up year to date about 13%, the Indian rupee weaker by just 1.9% and amongst the top 5 emerging market performers, 10-year bond yields down about 45 to 50 basis points, and FX reserves still up a net $35 billion. A large part of the credit should go to RBI, which has manned our gates in a credible, clairvoyant, and decisive manner. This is best underscored by RBI's series of actions in the financial sector, where preemptive stern actions have probably helped deliver a soft landing of the personal and microfinance credit boom before it potentially spiraled into another financial sector crisis, as we have often seen in the past. The reason we are starting our 2025 outlook with an ode to the RBI for its prudent management of calendar year 24 is that given the kind of uncertainties and issues that the world is facing now, we need as much and more of RBI's steady hand, of course in tandem with the government policymakers, to ensure that India continues to carry the mantle of being a beacon of stability in an otherwise tumultuous world. And for that, in RBI we trust. With Governor Shaktikant Das's term having ended after a memorable 6-year period, Shri Sanjay Malhotra, the erstwhile Revenue Secretary, now takes charge of the institution with the responsibility of ensuring this trust not only continues, but also grows stronger. Our macro scorecard for calendar year 25 reflects a positive rate bias for the Indian bond markets as shown in the slide. Over the past few months, the bands of uncertainty have widened around some factors, suggesting that navigating the bond markets in 2025 may be a bit more challenging than in 2024. Let's take a deeper dive into 3 factors where we believe there is more visibility and certainty of the path ahead. First, fiscal policy and government security demand supply. Both these factors continue to be strong tailwinds into 2025, similar to that in 2024. Strong domestic demand, along with continued foreign investor flows and potential open market operation purchases by RBI, will keep government securities well bid and market technicals positive. Second, index and strategic foreign investor flows. India bond markets are now in the process of inclusion into all 3 relevant EM bond indices: JP Morgan GBI EM, which has already happened, Bloomberg Emerging Market Local Currency Index, and the FTSE Emerging Market Government Bond Index. Total index inflows itself should total about $35 to $40 billion by March 2026. And third factor, external balances. India's current account deficit has been steady, hovering around the 1% mark for the past few years, and we expect the same to continue into the next year as well. Capital flows by their very nature are and will remain fickle. However, we believe balance of payments should still remain comfortable. Moving on to the 3 factors where visibility has become clouded and may need to be watched closely. First, global interest rate and FX environment. Given the lack of clarity on Trump 2.0 policies and their impact, US monetary policy backdrop is likely to be more uncertain in 2025. We prefer to start with a neutral stance on its impact on India bond yields. Consensus view on FX seems to be US dollar strength and emerging market currency weakness. The wild card, of course, is any potential Chinese renminbi depreciation or devaluation as a counter to Trump tariffs, which could lead to severe ripples across EM currencies. Clearly, currency movements and related central bank actions will be critical for rates assessments as well. If consensus view of US dollar strength does indeed turn out to be the way forward for this calendar year 2025, we would expect rupee weakness of about 1 to 3% over the year, still outperforming majority of emerging market currencies. Second factor, systemic liquidity. Recent FPI selling frenzy has forced liquidity back into deficit on back of RBI interventions to maintain INR stability and then forcing the RBI to cut CRR in its most recent December policy. We expect RBI to continue with further measures in this direction, namely aggressive variable rate repo injections, FX swaps, as well as potential open market operations to buy government securities and inject liquidity into the system. And finally, third point, growth inflation imbalance. This is probably the most relevant point where the growth outlook has suddenly dampened after the Q2 print of 5.4%, while inflation risks remain elevated on the back of unrelenting food price shocks. We expect the balance to get better over the next few months as inflation quickly retraces back to the sub 5% levels, which would free up RBI's ability to respond better to downside growth risks. And this is what underpins our positive outlook for bond markets, as we expect the Monetary Policy Committee to be able to cut rates by about 50 basis points over the February and April policies. Through all this uncertainty, we still think space could exist for a further cut by June 2025, taking policy repo rate to 5.75% and overnight rates towards 5.5%. However, we remain mindful of the risks that global developments may not leave the RBI space to move that last mile. To sum up, despite the various uncertainties and imponderables heading into 2025, we remain positive on our outlook on Indian bond markets and expect interest rates to move lower, supporting a long-duration bias across portfolios with the intent to remain nimble in our strategies as the year progresses. The accompanying chart shows the impact we expect on different parts of the yield curve based on the key factors and may help investors arrive at an appropriate risk-return profile of their portfolios. We would like to highlight a few key investment themes. Firstly, while rates are expected to move lower across the maturity spectrum, the yield curve is likely to steepen significantly as shorter-end yields move lower on back of the positive liquidity and rate cuts. Hence, our positive view on 3 to 4 year AAA corporate bonds, which can benefit from this curve steepening, rate cuts, and spread compression. Second, given the favorable demand-supply dynamics in the government bond market, along with the government's focus on fiscal consolidation and the strong macro fundamentals, we remain positive on our outlook for the longer end of the government securities curve. And finally, corporate treasuries should continue to farm out their stable liquidity surplus to benefit from the upcoming rate cuts and liquidity easing in our view. In conclusion, the coming year is bound to be eventful and exciting from an investment perspective, with a fine line between being nimble-footed and holding the line. In such an uncertain backdrop, India is fortunate to have a strong macroeconomic fortress and, more importantly, a resolute RBI at the gates to raise the guard as and when required. As we head into 2025, for India bond and currency investors, that is probably the biggest reassurance of calm amidst the chaos. We believe Indian bond markets are well armed to navigate through the challenges posed by 2025. Thank you. Wishing all of you a happy new year and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.